Have you ever wondered why the price of your favorite coffee keeps rising? This is not a random occurrence, but a result of a complex economic phenomenon known as inflation. Inflation, in the simplest terms, is a general increase in prices and a corresponding fall in the purchasing value of money. It's like an invisible force that slowly but surely eats away at the value of your money. Imagine having $100 today. Due to inflation, that $100 might not buy you as many goods and services next year as it can today. Now, you might be thinking, why does inflation happen? Well, there are several factors at play, and we'll delve into those in the next scene. But for now, just know that inflation is a normal part of a healthy economy. Inflation doesn't just affect you or me. It impacts everyone, individuals, businesses, and even governments. For individuals, it affects how much we can buy with our money. For businesses, it impacts the cost of goods and services they provide, and for governments, it influences economic policies and decisions. But it's not all doom and gloom. While inflation might mean that your money doesn't go as far as it used to, it can also be a sign of a growing economy. When the economy is doing well, businesses raise their prices, wages go up, and the cost of living increases. This is inflation at work. Understanding inflation is not just for economists or financial experts, it's for everyone. Because the more informed we are about how our money works, the better decisions we can make to protect it. So, if you've ever been baffled by the rising prices of goods and services, or wondered why your money doesn't seem to stretch as far as it used to, you're not alone. Inflation is a crucial economic concept that affects your everyday life. But don't worry, we're here to help you understand it better. So let's dive deeper. Inflation isn't a random occurrence, it's influenced by various factors. Let's start with the first cause of inflation, known as demand pull inflation. This is when demand for goods and services exceeds their supply. Imagine a hot new gadget hits the market and everyone wants one. If the manufacturer can't keep up with the demand, they might raise the price. That's demand pull inflation in action. It's like being at an auction where everyone wants the same item. The higher the demand, the higher the price. Next, there's cost push inflation. This occurs when the cost of producing goods or services increases, causing businesses to hike their prices to maintain their profit margins. If the price of oil skyrockets, for instance, it becomes more expensive to transport goods. Manufacturers may then pass these extra costs on to consumers, leading to higher prices across the board. It's kind of like when a restaurant increases the prices on its menu because the cost of ingredients has gone up. Finally, we have built-in inflation. This is the expectation of future inflation. If businesses expect their costs to rise, they may increase prices in anticipation. Similarly, workers might demand higher wages to keep up with expected price increases. This creates a cycle where the expectation of inflation leads to actual inflation. It's a self-fulfilling prophecy, if you will. Each of these causes can occur independently, or they can interact and compound one another. For example, high demand might lead to increased production costs, which in turn could lead to cost-push inflation. Similarly, the expectation of future inflation can exacerbate demand pull and cost-push inflation. Inflation isn't inherently bad. Moderate inflation can stimulate economic growth, but high inflation can erode purchasing power and create uncertainty. That's why central banks monitor inflation closely and adjust monetary policy to keep it within a target range. Understanding the causes of inflation can help us make informed financial decisions. By knowing what drives inflation, we can better anticipate its effects and adjust our plans accordingly. We'll delve deeper into the effects of inflation in the next scene. Stay tuned. Knowing that inflation exists is one thing, but how do economists actually measure it? This is where the Consumer Price Index, or CPI, and the Producer Price Index, PPI, come into play. Let's start with the CPI. The Consumer Price Index is like a shopping cart. This cart doesn't contain apples and oranges, but rather a mix of goods and services that an average household might buy. This could include everything from a loaf of bread, to a haircut, to a new car. The Bureau of Labor Statistics, or BLS, checks the prices of these items every month. If the overall cost of the cart goes up, we have inflation. If it goes down, that's deflation. But what if you're not a consumer, but a producer? This is where the Producer Price Index, or PPI, steps in. The PPI is a measure of the average change over time in selling prices received by domestic producers for their output. It's like the CPI, but for the production side of the economy. If the prices that producers receive for their goods and services go up, that could mean inflation is on the horizon. Now, let's look at an example. Imagine the price of wheat goes up. This could lead to an increase in the price of bread, which would be reflected in the CPI. The PPI would also rise because the producers of bread are receiving more money for their product. These indices are crucial tools for economists. They not only measure inflation as it's happening, but also help predict future trends. For instance, if the PPI is rising but the CPI is stable, that could be a warning sign that consumer prices are about to go up. So the next time you hear about inflation on the news, remember the CPI and the PPI. These are the tools that economists use to keep a pulse on the economy, and they help us understand how inflation affects our day-to-day lives. With these tools, economists can track inflation trends and make predictions about future economic conditions. Inflation isn't always bad, but it can have negative effects if not properly managed. Let's dive into the potential effects of inflation. The most immediate effect that comes to mind is the reduced purchasing power. Imagine you're holding onto a $100 bill today. If inflation rises, the value of that $100 shrinks. You could buy less with that same bill tomorrow than what you can buy today. This is because as prices increase, each unit of currency buys fewer goods and services. But hang on, inflation isn't just about negatives. It also has a silver lining. Sometimes a little inflation can actually stimulate spending. Think about it. If you knew that the price of that TV you've been eyeing is likely to go up next month, wouldn't you be more inclined to buy it now? This kind of spending can boost economic activity. Now let's talk about another effect of inflation: income redistribution. This essentially means that inflation can affect different people in different ways. For instance, people with fixed incomes, like retirees living on a pension, could find themselves in a tight spot as the cost of living rises. On the other hand, business owners may be able to adjust their prices to keep up with inflation, thereby maintaining their income levels. Lastly, inflation can create uncertainty in the economy. With prices constantly changing, businesses may hesitate to make long-term plans or investments. This can slow down economic growth. Now that's a bit of a downer, isn't it? But remember, while these effects may sound daunting, they are not set in stone. The impact of inflation can vary depending on a range of factors, including the rate of inflation, how it's managed, and the overall economic environment. So what's the takeaway here? Inflation is a complex phenomenon. It's a bit like a double-edged sword. On one side, it can stimulate spending and economic activity. On the other, it can reduce purchasing power, redistribute income, and create economic uncertainty. Inflation is a double-edged sword that requires careful management. So, how can you protect your finances from the effects of inflation? The key is to be proactive rather than reactive. First, consider investing in assets that are likely to appreciate in value over time. Real estate, for instance, often increases in value, making it a solid hedge against inflation. Equities or stocks are another good option. When prices rise, companies usually increase their prices too, which can lead to higher profits and subsequently higher stock prices. But remember, while investing can provide a buffer against inflation, it always comes with risks. So, it's important to diversify your investments to balance potential gains with possible losses. Another strategy is to keep your skills up to date and marketable. Inflation often leads to higher living costs, and having a competitive edge in the job market can lead to higher wages, helping you keep pace with inflation. Finally, consider inflation-protected securities, like Treasury inflation-protected securities, or TIPS. These are government bonds that automatically adjust with inflation. So as prices rise, so does the value of your investment. Remember, there's no one-size-fits-all solution. What works best for you depends on your personal financial situation and risk tolerance. But by implementing some or all of these strategies, you can protect your financial future from the uncertainty of inflation. With these strategies, you can make your money work for you, even in times of inflation. Inflation is a complex topic, but it's crucial for everyone to understand. We've journeyed through its causes, how it's measured, its effects, and the steps we can all take to guard our finances. Remember, knowledge is the best defense. Keep questioning, keep exploring, and most importantly, stay aware of the economic weather surrounding you. Next time you notice a price increase, ask yourself, is this a sign of inflation? And what can I do to protect my finances?